Welcome. Today, we're taking a topic that usually causes a massive, and I mean massive, headache for incorporated small business owners. Yep, we're talking about GST and HST. But don't worry, we're going to transform this from a stressful chore into a simple, manageable money routine. If you're operating through a corporation, you know that keeping your tax compliance in check can feel totally overwhelming. But it really doesn't have to be. By the end of this quick explainer, you're going to have a clear roadmap to keep your GST and HST visible, trackable, and honestly, pretty stress-free.
To get there, we're going to use a really straightforward 5-step system. First, knowing your active status. Second, keeping separate funds. Third, knowing your method. Fourth, managing deadlines. And fifth, keeping clear records. After that, we'll look at what good enough actually looks like in practice. Let's get started.
So let's start by looking at the core problem here. Why does GST/HST cause so many surprise cash crises for owner-operators? Well, the answer is simple, but man, is it dangerous. Surprise tax bills happen when the tax you collect from your clients is dangerously blurred into your general operating cash. You look at a big bank balance, you think you're doing great, you spend it on regular business expenses, and then, boom, filing time hits. Suddenly, you owe money to the CRA that you literally don't have anymore.
To fix this, we need to completely shift your mindset. GST/HST is not a tax on your income. Actually, scratch that. It's not even your money to begin with. It is simply a tax you collect on behalf of the government. Your corporation is merely acting as a tax collector for the CRA. That money was never yours to spend. When you truly internalize this concept, your entire approach to business cash flow is going to fundamentally change.
That brings us to step 1. Know whether GST/HST is active. You just need to know if your corporation is currently registered or if you're approaching the threshold where you absolutely have to register.
The magic number here is $30,000. Registration becomes mandatory when your worldwide taxable sales exceed $30,000 in any 4 consecutive quarters. Now notice I didn't say in a calendar year. It is a rolling window of 4 consecutive quarters. Once you cross that $30,000 line, the rules change immediately. You absolutely have to start charging tax on your sales, tracking the tax you pay on eligible expenses, and preparing to make your remittances.
Once you're registered, we move right into step 2. Treat GST/HST differently from your sales.
And this brilliantly illustrates the physical separation of funds we're talking about. When money comes in from a client, your sales revenue and the GST/HST amount should never, ever be treated as one single number. Every single dollar of incoming payment needs to be split. Your business revenue flows one way into your operating cash, while the tax portion should funnel directly into a separate CRA trust account. Splitting it physically like this ensures the government's money never blurs into your day-to-day business operations.
To make that physical separation an actual reality, you need to build a rock-solid monthly habit. It's really just 3 easy actions. First, you receive the payment. Second, you calculate the tax portion of that specific payment. And third, you move that exact tax amount to a separate holding account. If you just make this part of your routine, the tax never disappears into your general cash, and I promise you, your stress levels at tax time will drop to 0.
Now for step 3. Know which GST/HST method you use. Don't worry, you don't need to master the complex selection process right now. You just need to know which rules apply to you.
There are basically 2 main ways to handle your filings. The regular method is the standard approach. This is where you calculate the tax you collected and you subtract the tax you paid on eligible business expenses. Those expenses are called input tax credits, or ITCs for short. The difference between those 2 numbers is what you remit. Alternatively, some businesses use the quick method. Under this method, you still charge the normal rate to your customers, but you remit using a simplified, prescribed flat rate. Because it's a flat rate, it completely changes how those input tax credits are handled.
So how do you optimize between the two? Well, the regular method is usually best for high-expense businesses. Think retail or construction, because you get every single penny of tax paid back. On the flip side, the quick method is often the clear winner for service-based businesses like consultants who have really low overhead. With the quick method, you actually get to keep the difference as income to compensate for the simplified bookkeeping. Makes sense, right? Knowing which method you use dictates exactly how you should be tracking your expenses.
Moving on to step 4. Stay ahead of filings and remittances. GST/HST deadlines should never arrive as a panic-inducing surprise. Okay, let's dive into this. Every single month, you need to do a quick check of 3 key things. 1.
What is your filing frequency? Are you annual, quarterly, or monthly? 2. When is your next filing deadline? And 3. When is your next remittance deadline? Keep in mind, the day you file isn't always the same as the day you have to pay. If you keep an eye on these dates, and you've been moving your cash into a separate account like we talked about earlier, you are always going to have enough money available.
Finally, step 5. Keep support that can be found later. This is all about maintaining clear records so your trail can be validated without any guessing.
Here are the exact types of supporting documents you literally must keep organized. You need the invoices you've issued, your receipts and bills, bank and credit card statements, your filing confirmations from the CRA, and clear notes for any unusual or weird items. And remember this, the CRA doesn't just want to see a line item on a credit card statement. Nope, they want the actual receipt showing the exact tax breakdown to validate your input tax credits. Having this organized before filing time is an absolute game changer.
So, we've walked through the whole system. Now let's talk about what good enough actually looks like in everyday practice.
You know you have a workable, successful GST/HST tracking habit when these baseline indicators are met. Your corporation's registration status is known. The tax you've collected is highly visible. Your expenses and the tax paid on them are tracked. You know exactly which method you're using. You have zero surprise deadlines, and your support documents are perfectly findable. When all of these are true, your corporation is structurally protected from accidentally spending its GST/HST. To summarize everything we've covered today, GST/HST becomes entirely manageable when it's tracked regularly, instead of trying to sort it all out later under extreme pressure. Routine always beats reaction. The immense peace of mind that comes from having this basic structural system in place means you spend way less time stressing over compliance and a lot more time actually growing your business.
Which brings us to our next step. To keep these items highly visible inside your regular money routine, you need to use the Built to Thrive GST/HST Quick Reference Corporation tool. It is perfectly designed to help Canadian small business owners just like you maintain this vital system. So I'll leave you with this final provocative thought. If the CRA reached out tomorrow to review your GST/HST records, would you feel total panic or complete confidence? Put these 5 steps into practice and you'll absolutely always be ready. Thanks for joining me for this explainer, and keep thriving.